world. We are getting those payrolls revisions. Let's go to Steve Leisman, who's been looking into that. Steve, what do you see?
I see the biggest revision we've had. I'd go back 25 years here. This may be the biggest revision ever, Sarah. We minus 911,000 payroll growth from April of 2024 through March of 2025 is 911,000 less than previously reported. What has happened now to the month over month, or the monthly growth rate, has gone from what we thought was 147,000 a month to now just 70,000 a month. So 1.7 million jobs is now 847,000 jobs created over that period. So over that time period, payrolls were quite a bit weaker. Remember, this is the period ending 5 months ago. This is the annual benchmark revisions that's done every year. This is a preliminary number. Over time, it tends to actually be revised a little bit higher. The revision to the revision ends up being a little bit higher. But right now, it's suggesting much weaker payroll growth. I will point out that this is definitely towards the high side of what I've seen from Wall Street analysts. And now you have to plug in you have to start thinking about, what does this say about today? In other words, this data is 5 months old. We won't know until the final revisions in February which month each of the weakness belongs to, but we do know a bit about which industries it belongs to. And we have a chart here, 880,000 from the private sector. The biggest revision came from trade, transportation, and utilities of 226,000, 126,000 off in retail. Leisure and hospitality down 176,000. Professional business services down 158,000. So widespread in the, I don't see it here. Not a lot in private education and health services, which was the big, you can see the recent revisions there. The second biggest revision that I have, Sarah, in my records is 2009 in the wake of the great financial crisis. And what had happened in that situation was some of the modeling was wrong. Some of the birth, death of businesses was wrong. This may be the case right now. We might have come into this year with much more weakness than we thought we had in the job market. It was okay. It seemed to be like the unemployment rate remained relatively stable. So whatever we were doing was okay to keep the unemployment rate, a separate survey, relatively low. But we were not creating as many jobs as we thought. And I know that some Fed officials, Chris Waller among them, think this is part of a broader story of weakness in the job market that should cause the Federal Reserve to cut. And we'll see what happens now to the, I don't know if we're able to get you right away an update on Fed funds futures, but certainly the market was primed for 325 basis point cuts this year. And we'll see if I could take a look right now to see if there's any more play on a 50. And there isn't, and there probably shouldn't be. I don't know that this will motivate Fed officials to do more, but it will motivate them to do something.
Right. Those were my two takeaways, Steve. Number one, this sort of ratifies the idea that they should cut next week and that job growth has stalled and has slowed and looks even worse than they originally expected. And the last few months have been weaker. And then the second is my question about the process. So how were we almost 1 million jobs short in terms of, there have been questions lately about how this process, this data, the president raised it, he fired the BLS chief. Does this feed into those concerns about how the data was so off?
I think it should, and I'll tell you why, Sarah, because when I look at the history of these as a percentage of payrolls, actually they do a pretty good job when you look at the revisions as a percent, 0.1, 0.2, it's averaged about 0.3. This is 0.6. This is double the average. So, and let me just see if I can find out the last couple of years. Yes, and it was 0.4 in 2024. So the last couple of years have been quite a bit above average in terms of the amount of revision. What's happening here is we're getting jobless claim insurance data from the states. I don't know if the problem is at the state level or if it's at the federal level. Whatever it is, there's something not going quite as well as it used to go in terms of the ability of the BLS to gather monthly data. Here's the process, Sarah, which I'm sure you know, but maybe not every viewer knows, which is that we get it at the next month, the 15th of the month or the 12th of the month, we get it once. Then we revise it again. Then we revise it a third time until the annual benchmarks come along, We revise it on a preliminary basis and revise it again. We keep counting it and keep counting it, but it looks like the counting, as was evidenced in that big June revision on the preliminary stuff, is not as good as it was, and it's not as good as it was even on a annual basis. So we seem to be having a problem here, and something needs to change. I've often thought about the idea of, can we do better getting better data from the states on a more consistent basis?
Steve, thanks for that important number, maybe one of the most important of the day. Our Steve Leisman on the job growth revisions.